and welcome everybody to today's webinar, which we are hosting in partnership with FIS, and we're going to be exploring the path to 2030. My name is Martin Lawrence. I'm from the ValueExchange. We are a market research firm across the capital market space, primarily specializing in post-trade. So why are we having this webinar today? We're essentially having it to answer the question of how and where firms are making the business case to spend up to $280 million per year on platform and process transformation. And to do this, I am thrilled to have with me four fantastic speakers who each of which have significant expertise and are leaders in their field. So we have Sam Riley, who is CEO of Security Services at Clearstream. We have Andrew Murfin, who is a senior consultant for the Global Wealth Management and Capital Markets Integration at UBS. Bruno Campenon of BNP Paribas, as well as Mack Gill from FIS. Gentlemen, thank you all so much for being here today. Hopefully we're going to have a really great discussion. And to everyone listening, considering the expertise that we do have on the line, I really want this to be an opportunity for you all to ask the questions that you have. You'll see at the bottom of your screen, there is a Q&A chat box. If you have any questions as we're going along, please do put them in there and we will do our best to get to them at the end. The conversation that we're having today is really going to be Asia and Europe focused, and it's complemented by a call that we had yesterday, which really focused on North America, where we had speakers from DTCC, as well as Drive Wealth. And again, we had Mack Gill from FIS. That will be available. The recording of that will be available in the next couple of days. You'll be able to find that at the QR code that you can see on your screen. But importantly, this conversation really follows on from a major piece of research that we did in partnership with FIS, where we received around 350 responses to our survey, looking at what is the case for securities processing transformation. And that report is available to you all, again, through the QR code that you can see on your screen. To highlight some of what we're talking about today, we really want to go through some of the changing dynamic between the buy side and the sell side and the relationship between them due to some of the evolving needs of the buy side. So in general, anytime we speak with buy side firms, that they're under huge cost pressures, as well as having evolving needs from their own client bases. But buy-side firms are essentially needing to come up with cost savings of around 1.6 million per annum per fund, which is a substantial amount. And that evolving need from the buy side is really changing the relationship that they have with their brokers, with their wealth management, and it's really impacting the competencies required from these sell-side firms, as well as the client interaction that they have with their clients. And so Mack, I'll come to you first if that's okay, but really I just wanted to see how that kind of reconciles in terms of the conversations that you're having and the upstream client pressures and how they're impacting their own mission and operating models.
Yeah, thanks, Martin. And first, let me just say it's great to be on such an expert panel with Andrew, Bruno, and Sam, and a very interesting topic. Again, I think the research that you all have done has shown and put a lot of data around a lot of the interesting trends. And again, I highly recommend anybody listening to just download and get the data directly, because it's quite a rich data set. But I mean, one of the key things that came out of that, as you just outlined, was the ongoing cost pressure that we're seeing from the buy side. That's been a trend, and I think that is not necessarily a new trend, but it is accelerating, and we're seeing real data points on that there. And I think that again, that dynamic puts incredible pressure on all of us who are either sell side providers or those of us supporting the sell side. And I think that in its own right is of interest, and we all need to focus on that. But I think what's incredibly interesting overall is that it's coming at the same time as a lot of other market trends. And I think I think all of us on this panel have been in the industry for decades, and personally, I haven't seen as much change as what we're seeing right now. And when we look at market structure changes, obviously, T+1, we have that history from North America. We're looking at it certainly in the UK and Europe, and parts of markets in Asia. And I'm sure we can talk about that, but we also have market structure changes coming now in the US with the 23/5 or 24/5 or 24/7, whatever flavor you want to look at, but that's coming. We're all supporting US flow in one way or the other, wherever we are in the world. And that is very real, and it's happening, has real implications for all of us. And then we're also seeing, market dynamic changes with more retail engagement, and tied to that more crypto. Obviously that quarter by quarter, that's more of a factor. And I tag to that, it kind of feels like a tipping point this year in terms of institutional engagement with let's call it the wider digital asset infrastructure world, whether or not we're talking about stable coins or tokenization. So we have all of that going on, and we also have anchored to that the ongoing issue of technology. This is a technology industry, and very much based on that. And again, we're all on that journey of being, many organizations kind of anchored in technology that is 20, 30, 40, I might even say 50 years old at this point. And a lot of that's been very much fit for purpose for a long time. But we're coming to that tipping point where organizations are looking at cloud and looking at a lot of new technology opportunities to get to that holy grail of being able to use AI as an example. We're all on that AI journey, but you can't just slap AI onto creaking legacy infrastructure. So there's a lot there, and I've thrown a lot out there to unpack. But if I'm looking at the industry, all of those things are happening at the same time that collectively we're trying to deal with that buy side cost pressure, who are the ultimate clients. And I think that what that is ultimately, and we can unpack some of this, is I think tremendous industry change in the coming years. I think it's been a fairly static industry, but we have a lot of new market entrants coming in, and I think market structure is changing, and it's going to be fascinating. I think the next 1, 3, 5 years. So I'll pause there.
Thanks, Mac. Yeah, I think that that relentless pace of change is definitely felt throughout the industry. It really is seeming like it's changing at a pace we haven't seen before, as you mentioned. Andrew, from your side, thinking about it specifically on the wealth management side, what are you seeing with regards to pressures from the client base that you're supporting?
So I think there's a bit of an echo, so I think maybe other people can go on mute. Look, I think the interesting thing from the wealth management is a little bit, I think, taking some of the points that Mac just said. It is, I think, what we see in the last sort of 3-4 years coming out of COVID in particular is the sort of demands and the way that wealth clients want to interact with us, the way that they look at the relationships or the relationship they have with an organization, say like UBS or other wealth managers. It's an acceleration away from, say, traditional models and traditional ways of doing business, which was sort of very, the face-driven, your relationships with the advisor, that's your dynamic and that's your sort of entrance point into the organization, to something that is much more digital and having combinations. I mean, you've got new entrants in the market who are fully digital and provide just totally just digital solutions to clients. I think depending on the client base and the level of wealth, you actually have to have now a much more flexible model where you can offer still, for certain generational clients, that face-to-face and that sort of that relationship. But actually increasingly what they want is either a combination of that. So you need to have, real-time digital tools that are sort of agnostic to assets and ecosystems that allow clients to interact in the way that they choose to interact. They're looking for, rapid access to information, real time. Sometimes clients now want to be able to have ideas proactively sent to them, trading ideas, investment ideas, research ideas sent to them. They don't want that in a meeting. They want that either through their iPads, through their iPhones, the different dynamics. So from a front end and the way that we sort of interface to clients, it is becoming much more sophisticated, much more dynamic, and that has to flow through, because otherwise your risk is that you have this great front end where you have great tools that clients can access. They can model their own portfolios, they can make their own investment decisions, but you've got to look at how if you have that digital front end. The challenge for a lot of wealth managers is that the back end is to Matt's point, it's still very legacy, it's mainframe driven in cases. It's still paper driven, even when you look at how you onboard a client into the organization. So the challenge for wealth managers is a lot of investment has gone into the front end to make those tools and to give clients access to those types of tools and that media into the organization. What we now need to do is play catch up at sort of going through the sort of the middle office into core operations. Is how do you take that digitization all the way through? Because clients just want a seamless service. Wealth clients they don't necessarily want to pay for post-trade, but they expect a top quality service all the way through, and for that to be utterly seamless. I think that the challenge that wealth managers have is that, I think you'll see that in some of your slides, and some of the wealth managers need to sort of ramp up the investment in the post-trade infrastructure to play catch up to some really fantastic technology and capabilities that are there at the front end now.
Yeah, that's such an interesting point as well, and that gap that we have between what the clients see on the front end and what you're all managing behind the scenes. And you talked about paper and faxes and all those good things that we should have got rid of many years ago that are still happening behind the scenes, and that's going to just inhibit us as we try to move forward and deliver even more real-time, even more instantaneous solutions to your client base. But Bruno, just coming over to you from more from a security services provider, different types of clients probably that you're managing as opposed to Andrew. What kind of pressures are you seeing from your upstream clients?
Well, I would structure it in two ways. The first thing is that you have a number of things that are not changing, and that's about cost reduction. We've seen that for the past 20 years. That will probably increase in the coming years. That's one thing, and this is increasing in a moment with the ETFs that are putting a lot of pressure, particularly on brokers, with the retail world that is increasing, etc. So cost is one thing, and that leads to a second point, which is volumes. There is a surge for volumes, and this is true across the entire settlement cycle, and it starts with the sell side, certainly. The third point is about the search for liquidity. Depending on the typology of service that you're looking at, the search for liquidity becomes more important. If you go to more the voice elements, so the eye touch, the liquidity is extremely important. So those are elements that our clients are coming to us to help. Then you have a number of things that are changing. First, the pace of change has been accelerating. We've been talking already about a number of things happening in the digital space. This is something accelerating, although the volumes going through it remains very limited. But the pace of the changes required and the number of proof of concept, number of things in which you need to get involved is increasing. The second thing that has been changing quite significantly over the past, would say 2-3 years, is the risk-weighted assets and the specific focus that our clients are having on their capital and equities. If you look at brokers, this is probably central to any of the decision, and hence this has changed a little bit the typology of services that we're providing to our clients, with a bit more focus on how can we relieve them a little bit from that kind of risk-weighted asset pressure in taking over some of their responsibility. So this is something that's been changing quite a bit. And the last bit I'm saying as changing in the market is that you start to see more specialization from our clients. So if you look again at the sell side, be it the IB, the market makers, the retail brokers, the aggregators, you start to see much more specialization in the way brokers in particular and IBs are providing services on the market. And that specialization drives the cost down and increase a little bit the efficiency of our clients. So specialization is probably the thing that will evolve most in the coming years.
Yeah, thanks, Bruno. And then Sam, I'll come to you lastly. So that specialization, that change in client dynamics that we're seeing, how is that impacting on you being more from the infrastructure side?
Yeah, thanks, Martin. And I think if I look back to the first slide that you had, of course, in effect, we're not on there because we're on the other side, right? So we've got the buy side, the sell side, and the infrastructure, so to speak. And I think all of the guys before me have touched on most of the points. But I give it from an infrastructure perspective. I think where we're seeing certain aspects of the sell side now not needing to go through, the buy side not needing to go through the sell side. And in fact, the sell side, even maybe not wanting to have to deal with some aspects, right? So if I think about sponsored access models on CCPs as an example, right? The ability to be able to, and Bruno touched on liquidity, but if I think about collateral management and aspects around collateral management, we're seeing that for sure that is a trend that is there. The ability to access information and data is moving at an incredible pace, right? And I think how we use the data and whether it be at the sell side, whereby we often get requests in terms of being able to understand the capital implications at a desk level, right, in a broker dealer, versus what a buy side needs to understand in terms of things like predictive settlement and be able to understand how much additional cost. And Bruno touched on the cost evolution is not changing. I think it's pushing right through the chain. It used to be a much more of a sell side challenge. It's now become, I think, right through the chain of intermediaries, so to speak. The last thing I'd point out is just on the I think we've moved from changing digital and the way we think about digital from it being a completely revolutionary aspect of the industry to a very fast-paced evolutionary part of the industry, right? Because we haven't seen growth of new asset classes around digitized music or digitized other types of products. It's happening, but I think what we've done so far in the industry, which we're seeing across buy side, sell side, is driving the need to change our platforms a little bit in how we speak to each other, because we're digitizing the existing way we do things. And that's certainly an impact that we're seeing, whereby clients can't afford, obviously, to re-platform themselves, right? But need to adjust the technology in a way quick enough to be able to at least keep up with the pace. And my last point is something we should touch on a bit more, is that the growth of some of the new players, whether it be neobanks, neo-brokers in the marketplace, is driving different business models, is driving different ways of doing business, which means that the existing, maybe larger players or existing players that have been around a longer time are having to rethink their model, which touches back to what Bruno says, is either becoming more specialized, right, or really need to really rethink what they're doing.
Thanks for that, Sam. That's great. And I think we've gone through there between all of you some really good insights into some of the pressures that you're all under in supporting the buy side and the changes in their evolution. I just wanted to quickly also show, I said at the top that the case for transformation really is that some firms are looking to spend up to $280 million per year on this transformation, which is really quite a staggering amount. And what we're actually seeing is that's coming across, some really challenging things to do. So if you think about, the core system replacement, the legacy that we have, the challenges in doing that, and firms are looking to spend on the tier one side up to $130 million to do that, with a really, substantial expected ROI that you would get from that, but also changes across process and data automation. data has obviously been a very important component of everything we do for the last few years now. And then those new technologies, Sam, you mentioned predictive analytics, how AI can be used to differentiate services. So some substantial spend. And what we're actually seeing with regards to who's spending that money, it's actually the mid-tier firms at the moment who are kind of outpacing the other sized firms, especially when it comes to really doing that legacy platform changes. And so, Mack, I'm gonna come to you again first, if that's okay. But how does that all come together? If you consider everything we've already talked about so far, all those changes we're facing, the T+1, and we haven't talked about 24/5, mobile first, digital assets, private markets, etc. When firms are approaching you to provide their technology infrastructure over the next 10 years, what is it that they're really asking for that's going to solution them across all of these different factors?
Well, look, I think back to the earlier slide, I think the thing that we're seeing that's standing out is the increased investment in core system replacement. That market wasn't so significant for quite some time. People were just managing, running the bank and managing their systems, but we've seen that pivot, given all the trends we've been talking about. A lot of it comes down to being able to take your core systems and into a modern architecture. Frankly, most institutions don't yet have that yet. They haven't even started the journey. But what was interesting in this research was to see the level of spend. I think even more interesting was kind of the expected ROI. I mean, that's significant ROI, and that's tied to, again, the whole process and automation. So we're seeing that shift because it ties to all of these different elements, and really comes down to competition. I think Sam and made the point too about just market dynamics changing. I think an interesting part of the new technology infrastructure we have now as an industry is that it allows the neobanks, the neobrokers to come in and have that scale from day one. That's the whole benefit, or one of the benefits of a cloud platform is that you can come in and you can tap into scale. Used to be tier one organizations with their mainframes were the ones that had economies of scale with their technology estate. That is no longer the case. Where you can have, as a small organization, you tap into an AWS or an Azure environment. And so I think that's one of the interesting underlying dynamics that is allowing more competition and allowing, that, and I think, as I said earlier, this shakeout over time with that dynamic, plus all of these new business models are coming into play. So I think, but again, back to the research, I think it's really pulled out the fact that people are waking up to that, and obviously tier ones, but tier twos especially, because tier twos are in that middle ground where they have to adapt to be competitive. They don't necessarily have the scale and general business scale of a tier one, and they have to figure out whether specialized. That point was made earlier, and where they have the right technology estate to support that. So we're definitely seeing a lot of interest and activity in that tier two segment as well. So I think those are some really important points coming out of the research.
Yeah, thanks, Mack. And Andrew, so back to you, just regards to maybe going into a little bit more detail around some of the stuff you were talking about earlier. So, I mean, how are firms, really making that change internally to support some of the pressures that you said, and how is the likes of UBS, transforming what they're doing to support their client needs?
So I think just taking up a couple of the points that Mack just made, I think one of the prohibitors in the past is if you're running to support say a global wealth business on a massive mainframe that's 40 years old based on COBOL, you're paying a fortune in terms of running that platform. Actually, and then you look at the cost, the traditional cost to replace or rebuild, which runs into 150, 200 million for a big core banking platform. That's prohibitive. I mean, you'll never get, certainly my experience of running operations is you were never able to get that sort of multi-year investment to be able to do that. But the game changer now, and certainly what I think organizations like UBS and others are looking at, is when you start to look at AI, you start to look at Gen and agentic AI, actually you've got different ways now that you can effectively modernize your platforms. That you can now software development using AI tools, agentic AI, to rewrite code from COBOL to Java. You can do that for a few $1 million, get it onto the cloud, modularize. So actually, people like UBS and others are actually looking to fast track actually the way that you can modernize those platforms using AI capabilities, because of the speed and the relatively low cost to do that. So in the past, if I was looking to try and say, I need to replace all of my clearing and settlement platforms, my corporate actions, tax reporting, and you got the traditional estimate, $250 million, and you're going, well, that's just never going to happen. Actually, you can start to really rethink that now. And you can start to rethink the way that you want to go onto cloud, the way that you can modularize your platforms, and then through that mechanism, and therefore you're not necessarily having to, you can just modernize those platforms, and then what you can do on top of that is put your new orchestration layer on top of that, whether you want to call that a GUI workflow orchestration. So actually you start to then say, you don't have to have people who then have to go and access all of those multi-platforms you have underneath. Actually, if you're really smart now and it's on the cloud, all of your operations people sit there and they sit above those platforms. They're sort of asset agnostic, I said ecosystem agnostic. You just pull the data you need to do your job, and the workflow is able to automate, prioritize that for you. So you can modularize your underlying platforms, but you don't want still people to have to go into those platforms and then try and do their tasks and their work within those platforms. Actually, what you then do is then you're building those layers above the platforms. And that's where you can really start to change the way that you can start to use, whether that's Gen AI or agentic tools. And you can start thinking about how you're going to mix agents and real people. You can start to really prioritize really quickly, whether that's by risk or by client. You can really change the dynamics of the way that people do their jobs. That is all API driven. It's all real time as well. So actually, what I'm seeing in the last sort of 12, 18 months is a bit of a revolution for how you do that. And actually the ability to really accelerate at a much lower cost price. And at the end of that, you can actually see a very different environment, and it's not really a complete rewrite in the traditional way of doing things. So I think that's really exciting, because I think for post-trade, we've always struggled in saying we never get the budgets we need on a multi-year basis. If you can really shrink down that cost significantly, and you can start to then look at an overall architecture all the way through from the client downstream, that is in the way I've just described, you can achieve that in sort of 3 to 5 years, as against probably 10 plus, which it would have taken you historically.
Yeah, great. Thanks, Andrew. And then, so one of the things we talked about there, Andrew, a little bit, and maybe Bruno, if I come to you, we talk about legacy and some of the challenges of legacy platforms. And the research showed that firms are still spending, I think 57% of their spend goes on legacy, which we know is potentially substandard. So considering that spend that still happens on legacy, plus the drive to what we're trying to achieve with new technology, how do firms really balance that, and how do they innovate?
I trust both Mack and Andrew definitely touch base on the cost of that legacy and the fact that you have to deal with it. So it's a must. And this legacy probably costs you even more than the regulation that are changing at a quick pace. So there is a need for rationalization, and all our clients are coming to us to see what are those important things for them versus what are those things where they can rely on someone else to help them with. So there is a refocus on those activities that people want to excel in and people want to grow, while some other activity might be something secondary to them where they don't have a differentiator, and hence they decide to outsource this. This has been even heightened, I would say, with the arrival of the fintechs, because the fintechs address each and every of those points with solutions that are quick to market. The problem with this is that it's a bit overpopulated and sometimes a bit blurry. So you need to select precisely what you want to do with who. Unfortunately, very often in that space and in the digital space more globally, it's more is sometimes less and less is sometimes more. So you need to be very careful in how much you go with those new technology, new partners that can help you with their solution, because it can drag you into a lot of costs for results that might be blurry. So what we see is that there is a selection of partners as opposed to a selection of service providers. So we see rationalization from our clients, particularly the large clients, but it's also true for the second tier, of just using a limited number of partners that will help them to grow. And I would say that ultimately what they're looking at, what they're searching, is the efficiency and the appropriate model where they need to focus. And they are looking at people that will shield them a little bit from complexity through solutions that might be fine-tuned, that are not off the shelves, but rather fine-tuned solutions to help them through their day-to-day problems. So very much a shift from full, management of the legacy to a bit more outsourcing to people that can shield particularly sales side, but that's becoming more and more true for the buy side complexity.
Yeah, that's a really great point, Bruno. And I think, as we do that, so I think Bhavesh mentioned yesterday, I think he said today's new technology is tomorrow's legacy. And so when it comes to selecting who these partners are that we are going to engage with, it needs to be partners that are going to allow us to continue to develop in a sustainable manner. Sam, if I can come to you again just quickly. So one of the things our research showed as well is that there's been a bit of a change in kind of regulatory dynamics, where they're generally more principle-based these days and slightly more open-ended. So how do you kind of view that landscape versus the traditional COO kind of to-do list today? And do you think that the way that the regulatory dynamics are changing gives a bit more room for firms to decide how they're going to invest in their operating models?
So I think there's a combination of regulatory change, right, which we've obviously seen an incredible amount over the last 15 plus years, right? Which has, if you like, a little bit taken a lot of the resources that have been, could have been used for legacy renewal and other aspects in many of the organizations, and been focused on obviously abiding by those regulations. I think we're going through a slightly different phase at the moment. I mean, if you look at what's happening across the world, is the question around, in some areas, do we have too much regulation, whilst at the same time you've got challenges. And if I go back to that first slide you were talking about earlier around, in terms of investment, in terms of the smaller companies, well, of course it's going to be smaller investment that they're putting into legacy, because the reality is they don't have much, right? And it's their ability to become quite nimble and move with the times and challenge the existing models. And that's why I draw the conclusion connection rather with regulatory, because what you're seeing now is a couple of regulatory changes, particularly in Europe, like MiCA, for example, on the digital asset space, right, which is opening up for opportunities, but also this kind of ability to interoperate across multi-jurisdictions, right, in a way that is challenging the existing business models of organizations and definitely traditional organizations. So you've got this kind of situation where I think in three areas you've got existing regulation, which in some cases maybe is overburdensome and maybe a competitive disadvantage for looking at region by region. You've got opportunities. We've talked about digital currencies and digital assets and the regulation around that. And then you've got obviously the aspects of, in my mind as well, kind of those new, and Bruno talked about them, whether it be fintechs or new operators that are really challenging the business model, which is touching both of those other two aspects.
Thanks, Sam. Mac, I just wanted to drill into some of the, the specific things that are happening across the markets and changing across the markets to just get your view again on what your clients are approaching you about. So obviously T1 is something that we have briefly touched on and has been huge change for the North American markets. We obviously have the UK moving to T1 along with the EU in 2027 and actually having to move some of those post-trade processes around, confirmation allocation to T0 by the end of 2026. The Asian markets are obviously having discussions around their move as well. Is that a big driver of change for you? And obviously what we saw from some research in North America was that actually a lot of people didn't change their operating models entirely. They just changed some processes and threw people at the problem. Are you now starting to get engagement on proper platform change and automation?
Yeah, it's an interesting topic, and I think it's from a UK and Europe perspective, it's phenomenal that we have all the lessons, and again, a lot of organizations, obviously being global, we're involved in that already, and there's some regulation positive, others perhaps can be a bit burdensome. I mean, certainly in the US with the new administration, there's a clear direction of travel to less or lessening of regulation, and that does open up some flexibility, I think, generally for people's change budgets. But to your point earlier, but for T1 in North America, I think the biggest takeaway was that yes, it was a success, and I think objectively looking back over so far this year with the volatility, the benefits to margin and everything else, I think is very widely known from that shortening to T1, and so I think that's a real positive for the industry over here in the UK and in Europe when we look forward to those benefits. But I think the way to get there, you got to look at the lessons. And again, to your point, given the time frame, and given this was somewhat new at that point to North American organizations, a lot of people didn't get involved in core system change. They added operational teams. They shortened current process, but it was not necessarily a big shift. And a lot of folks, the North American market is especially mainframe based. And when you look globally, there's even a higher percentage of mainframe processing in North America. And so there was a real move into micro batches to be able to hit the timeframes required, but still running on batch processing. So it hit the target. It has been a success, but the lesson learned and what the conversations we're having with a lot of people in the UK and Europe is, hey, look, we have time over here in order to make change, and instead of just ticking a box for T1, again, the whole essence of shortening the settlement cycle is to be able to do as much as possible in a very automated way on T0. And so a lot of interesting conversations are, well, let's get ready as an industry for T0, not just take a box for T1. And I think that's a very positive discussion, because it ties, getting ready for real-time intraday processing touches a lot of the points we've made over the past, half an hour. Andrew, Bruno, and Sam have all made, those points about the benefit of real-time processing. And so by getting there and making those changes and making the core legacy change, starting this year into next year into 2027 is going to be putting organizations and the market overall in a much better position in order to be able to not just have a short settlement cycle, but then just look at the ability to handle digital assets, the ability to have a better infrastructure for new automated processing and AI, et cetera, et cetera. So I think that's the opportunity that the UK and Europe and Switzerland have in terms of that lesson learned. I think it's a very clear lesson, and I think a lot of organizations are taking that and thinking ahead. So that's I think that's really the focus for a lot of people this year.
Martin, if I can just jump in and just because I think there is one very significant difference, right? I don't disagree with Mac. I mean, there's a lot of lessons learned that we can take and use, right, from a Europe perspective on T+1. But the reality is that in Europe we're 29 countries, right? If you include the UK and Switzerland in that group of right. And Bruno touched on it earlier, and we take ETF, right, and we take the growth of the wealth and the retail space, right? And you might be buying one ETF, but it doesn't matter if you're buying it in the UK or in Germany or in Italy or France or wherever, it might be the same ETF. But you don't have in the US the realignment types of challenges. So I do think the time that's going to be used as we move forward up until October 2027, which is the timeline at the moment, is the question is what are the business model changes we're going to make? And we saw some business model changes in the US, right? But I think the business model changes might be more significant in Europe, at least, and maybe as we see this in Asia happening as well, than we would have seen in the US, right? And what does that do on technology and platforms and other things? I just want to throw that in, Martin, but sorry to take you off track.
Absolutely, Sam. I mean, the challenge of moving the EU and UK is certainly a much bigger beast than the challenge of moving the North American market with the single depository. And I do feel a bit for Giovanni Sabatini with that large project that he's trying to get forward by 2027, which is quite.
But he's doing well. He's doing well.
Yes, yeah, absolutely. Bruno, if I can just come to you. So outside of T1, another topic that's always quite dear to my heart is asset servicing. And so how are you, with Europe, obviously there's a lot of focus around ESG, etc. How are you seeing the evolution of change to support asset servicing, and how is that impacting the technology stacks, etc., that firms are needing to use to support that?
So thanks very much for that question, because the asset servicing is often put a little bit behind any automation we can do on the settlement side. And just to say a final word on the T+1, T+1 is very much about the settlement. And at the end of the day, what we're looking at the moment is not particularly enhancing the settlement capacity that we do have. If you take Europe, T2S is already T0 compatible. So it's not the problem is not particularly on settlement. It's a bit more on the asset servicing and how much you can make progress in that field. Our friends from for watching us from APAC knows it very well. If you take India, India has moved to T+1. They are not almost T0 compatible. No problem on the settlement side. But if you look at the asset servicing and the corporate event processing, that's a bit more complex. The onboarding of clients and the nitty-gritty of that onboarding is still very complex. So where you can make saving today in most of those countries is on the asset servicing and no longer on the pure settlement. Now, behind this, I mean, the transformation that we need to focus on, you have overall the efficiency. So asset servicing is one thing. There are a number of initiatives on the market to which many of us are participating, the like of the proximity or this kind of thing, that are helping a refocus from many institutions on the core services that they will offer. And proximity is the vehicle that will invest on behalf of many of us on the market in order to improve the service. The more we can put in place such setup to the market, the better for the entirety of the settlement cycle, and not only for the custodian or such and such participants. So we need to invest jointly a bit more into such infrastructure. You have a number of other points. I mentioned about the capital relief. If I talk about our brokers in particular, the capital relief remains extremely important. And again, to our friends from APAC listening to this, you have a number of solutions in Hong Kong. Hong Kong is a market that is particularly strong, I would say, in capital requirement for brokers to operate, and in what they call the FRR. And you have solutions that exist through third-party clearing in order to help them to relieve parts of those capital requirements. So there are solutions beyond the traditional settlement, beyond the traditional asset servicing as well, that can relieve a number of pressure from these guys. And the last bit, that is half asset servicing, half, I would say, global settlement footprint, is about the reach on the digital aspect of things, and what digital can do for T0, what digital can do for the the corporate event processing. At some point, you will have, through the smart contract, capacity to process corporate event in a much quicker manner than what we're doing today. this is far reach. This is not something that will happen tomorrow, but this is something, a space that I watch particularly because it will help having that corporate event kind of embedded with the flow itself. It's something that will be much more powerful than what we're doing at the moment, where if you take a settlement cycle, how many accounting are you performing through the chain? You got the client doing its own accounting, and then they go to a broker who does the accounting, and then you go to a custodian who does the accounting. You go to a CSD who's got the accounting. At the end of the day, you're multiplying the number of times where you take a picture of what's going on. That is awful. The interest that you may get with the digital side of things is that you may centralize this for once in one unique place that will be accessible by the bigger numbers. So I trust this is a space that we need to watch and that will make the difference in the future.
Thanks, Bruno. I just wanted to remind everyone, if you have any questions, please to put them in the Q&A section that you can see at the bottom. And then I just wanted to share one more slide, if I will, which is really around kind of the capabilities that firms are starting to expect from all of you around the new capabilities. So this idea of a multi-asset management platform. So we're all talking about, and we've mentioned it already a little bit, about digital assets, crypto, private markets. There's new kind of asset classes today, and people want to be able to do and manage all of that out of one single platform. Firms are now looking for rules-based exception handling, zero reconciliations, and I think what seems to be a very important topic, especially as we move to shortened settlement cycles, are these idea of predictive analytics, be that predictive trade analytics to understand your risks of trade fail. But what I would like to do, if possible, is if I could just come over to Andrew. When it comes to kind of the client base that you have, obviously from the wealth side, the idea of the kind of increasing asset classes and supporting digital, supporting crypto, supporting private markets, as you think about the transfer of wealth that's going through, like how are you really making sure that we're delivering on these capabilities, and are these capabilities lined up with what you're hearing from your own client interactions?
I would say with difficulty. So I think certainly, depending where you are in the sort of the world, I think different sort of on the wealth side, the client appetite for the types of assets sort of does differ. And I would say in APAC, for example, the appetite, the demand for crypto and for probably more for crypto, actually, not even less so probably tokenization, but around crypto is significant. And private markets as well is another one as clients are looking to diversify into obviously different asset classes with the geopolitical tension that's out there, the volatility we've seen, then actually diversification is even more important. And I think obviously with the change in the US and what we've seen with the sort of the pro and under the new president there, the sort of I guess the change at the SEC and therefore being pro crypto has suddenly changed the dynamic actually quite significantly very quickly. And I think a lot of firms have been, I think we've been, if you're taking a big wealth manager, you tend to be relatively conservative around some of these. Now you can't be as conservative because the client demand is there. And what we're having to do rapidly is say, well, how do we combine and bring in suddenly a crypto offering, particularly from an execution through to custody perspective, when you've got a very traditional mainframe type environment. I think to the points that have been made, you're starting to have to look at your partnerships, who you can use, who bring a specialist capability, and in the short term probably align that to your traditional sort of custody type models. But in the future, it's the challenge we will all have is how you actually do end up becoming much more integrated, because ultimately a client, they don't care ultimately whether you have one platform for traditional, one platform for for digital assets. Ultimately, when it comes down to the ledger, when it comes down to how they look at their portfolio, when it comes down to how they look at their reporting, it has to be integrated. That's why I think, you know, we're certainly fast tracking the concept of modularization, API cloud, what I've talked about, because the only way that you can really do that is you've really got to start to speed up that basically the architecture that you have underneath it. But certainly I think clients are, you know, rapidly I think evolving in their understanding of the new asset classes and their demand, because they want performance. Ultimately comes down to they want return on their assets. And with the volatility you're seeing in traditional, and a lot, you know, suddenly you're sitting very pretty, and the next minute you've lost 20% of your value of your portfolio. Actually, other asset classes become very important, private markets, in particular, other types of asset classes. And you could argue that crypto is even more volatile than traditional, but it is getting that balance across, you know, that diversification. Like, it's not going to be easy. I think all of us are sitting there with infrastructures that are, you know, historically have been very slow to enhance and renew. But actually, you've got to really focus on that now. And it goes back to the points I've made. It's about how you now do it, and using, I think, AI, agentic AI, Gen AI, to accelerate that capability. And put layers with it from a client. You can hide things from a client quite effectively, so the client just sees one overall portfolio, even if underneath it you're quite fragmented. And I think it's being smart, ultimately, how that you actually display that information to your clients, whilst you are re-engineering that architecture in the background. And I think that's where you're going to have to do it in the interim. But there's no doubt about it. You have to be, you know, multi-asset, ecosystem driven, partnership driven, bringing specialists in, where traditionally you'd have tried to do it by yourself. We'd have traditionally tried to sort of build our own capabilities. I think you now need to start looking at those partnerships, you know, whether it's in the fintech space, whether it's those specialist, you know, digital custody providers, and look at how you create that sort of, you know, a model where you're very comfortable with building a broader ecosystem.
Yeah, and, you know, especially in your business and wealth, I think that's just everything that's vitally important, right? Like you say, I think such a good point that your clients probably they don't necessarily mind what's going on behind the scenes. Essentially, they just want to get everything on their phone, and they want it to be instant, and they want it to be correct and accurate.
Yeah. That orchestration layer becomes you know, whether that is through AI or through your own sort of capabilities, becomes really crucial then.
Right. We do have one question through related to UK move to T+1, where they're saying, should trades be matched on T in order to avoid CSTR late matching fee, or whether CSTR late matching fee will be removed? I don't know if anyone wants to answer that one quickly.
Well, I don't have crystal ball, so I wouldn't certainly dare to say this will go one way or another. The only thing we held some weeks ago, a panel where Andrew and Giovanni were together, and what I can say is that you could feel Andrew was much more relaxed than Giovanni was, mainly because, as Sam mentioned, we're talking about 29 markets altogether. When you take UK, it's one market in its own right, versus EU that is much wider. I trust we'll get to find a solution. If I do a parallel with what has happened in the US. In the US with T+1, you may remember that one of the big issue was about the matching rate, or the affirmation rate. That was pretty low at the time, and we were all thinking that will blow the costs of the settlement to the roof. And ultimately, what we've seen is that the market has adapted, and they have reached now a level of affirmation that is much better on T, on per date, that is much better than anything that you've seen in the past. So what we see is that the market will be focusing on this and will adapt to it. So potentially one answer to the question is, if ultimately there is no move, neither from the regulator on the CSDR or from the technicality of the way the market is working, the market itself will adapt. And I would bet that we'll get the rates to move up to the level where this will not become a problem.
Thanks, Bruno. I think, we've obviously talked a lot about the changes that are driving transformation. We've also talked a lot about the different capabilities that different types of firms are requiring and different types of clients are requiring. Mack, just from your side, I think the headline number at the start, $280 million worth of transformation. How do firms start to think about, budget approvals to support that case for transformation?
I think it's tying together a lot of different themes that we have here. I mean, again, I made the point earlier that you shouldn't just be looking at T1. You should be tying it to, I think Andrew did a great job of highlighting the opportunities to normalize infrastructure across, traditional markets and new markets. You should be tying it to that. But I think overall, the point is you should be looking at not just cost management, but top line. I think that's a real shift in dynamic when we look at post-trade over a long period of time, last 10, 20 years. Historically, it's been a cost, it's been very much a cost budget. And it continues to be, obviously, given all the requirements on cost management that the research has shown and on that whole buy-side dynamic. However, the industry is shifting fast, and there's a whole competitive element to getting into new markets and offering new services that the post-trade, the back office environment has to flex to. And so it very much is top line associated. So I guess the view to our partners and clients, it really is a holistic, looking at a holistic view of that investment in terms of change. It's not always easy because it touches a lot of different elements of the organization, but it's something that those organizations that are able to do that and get their act together and make those kind of investments will be competitive, and I think that's the common theme for a lot of the points we've been discussing today. It's really a very different post-trade market than that it was, even 5, 10, 15 years ago.
And Mack, if I can just add two aspects, I'll just add in the mix, right? We didn't touch on data governance. I do think data governance is going to be a key driver for success of top line, right? As we think about top line, and the second aspect is how you link changes in the environment, whether other pressures around the business models or its regulatory, and use those to drive top line advantage, but also redevelop your legacy as a result, right? And if you can couple those few things together, it makes it easier to be able to obviously make a business case. Because as we've said earlier, the business case standalone, just to upgrade your mainframe, generally doesn't work.
I would sort of, I think Sam, you're spot on there in terms of using the regulatory changes going on to really then drive your sort of your re-engineering of your core platforms. If you're clever, if you also, I think if you're clever, if the firm has a broad AI strategy and a significant investment it wants to make, again, you can build your business case in around your core platforms as part of that AI strategy. And to your final point, Matt, you're dead right. I mean, I think we looked at crypto as a means to create a digital custody, digital asset capability, and you're using top line growth, client demand. Clients suddenly said we need a crypto capability, and the first thing you look at is, okay, how do we do custody then? And then you can start to then build that out into a broader as the first building block for a digital custody capability. So if you're smart, you don't do it standalone, because I think it's incredibly hard to actually ever come up with a case on a standalone basis. You have to be much more clever about how you use other drivers, other demands, and underneath that, therefore, what you're doing is then building out what you're then building your case around your sort of core platforms as part of that. And I think that's the way to go forward.
And Martin, if you allow me, I would just add one thing to this. Today, in today's environment, there's absolutely no way you can go back to the board or to the exco of your company with a project that costs 200 million with a return in 15 years. There is no way you can even think about it. And therefore, you have to look at the replacement of your legacy solutions or the investment in a different way. And I think you need to look first at the modularization. Sorry, that's a very difficult word for a French guy to say. Modularization of your infrastructure, whereby you touch bits after bits separately, and you ensure that by touching one thing, you do not have an impact on the entire rest of the infrastructure. I think Mac might smile at this because that's his daily job to look at this, but this is essential to modularize. That's the first thing. The second thing is to work on the interoperability. Interoperability across the various platforms, be it digital with legacy or across the legacy, is something in which you need to invest, because that investment's got a return that is extremely quick, in that you have much more flexibility for the future in that adapting your environment. And the last bit is partnership. If we take the example of digital, at the moment, we're working a lot with Swift in order to get them to work on a connector to the various blockchain of this world. Why would we all invest into connecting to those blockchain, taking nodes of all the blockchain, making sure that we're compatible with each and every standards available on the market, when you could get a market utility, and Swift is very well placed for this, to organize this for us. That way, we're no longer investing each on our side, but we're making the best of that infrastructure in which we have all invested over the years. So I trust it's a combination of those three elements that is important.
Thanks, Bruno. I think that's a great way to wrap us up. We are at the top of time. It sounds like we've got a very disparate to-do list, lots of questions out there, but it sounds like we've got also a lot of common answers to those questions. So I'd just like to really thank you all for being here today. Thank you all for being so candid and giving really great insights to the audience. Thank you also to the audience for joining. There were a couple more questions. I will try and get back to you with answers to that shortly after this. And I hope you all have a great rest of your day. Thank you, everybody.